I will respond in 10, 12 minutes. Your first question in a very different way. I think your question was, how did traditional bank respond to fintech disruption? The Asia story is almost reverse. How did the fintech with that disruption mindset react to traditional bank? And because both have a different meaning. The Asia story has been that the fintechs have figured out a way to work with the incumbents in a much smarter way, because they saw an opportunity in a very different lens what typically people think about fintech as a disruption to the incumbents' way of doing things. So let me explain that, and before I respond on the regulation around this space. What happened in Asia in 2016, 2015, partly due to policy intervention and the messaging which central bank did here, that we believe that fintechs have something quite amazing which traditional bank don't have. One thing, they understand customer pain points better than the traditional bank, because the founders typically are from banks and they have seen certain problem close to their heart, or they've experienced a problem and they use technology to solve it in the best possible way. So their understanding of consumer pain point is far better than incumbent. One good thing. Second, they used extremely agile and nimble technology to drive that experience. So they build fabulous tech stack, they use great user experience, and they drive their solutions to the consumers with the need they have. And the third is that they have a tremendous ability to agility to pivot to changing demand of consumer as they interact with the customer in their own life journey. So the fintechs in Asia had kind of logically split themselves into two groups. One group of fintech who stayed on providing competing financial services, especially unbundling the inefficient services which banks were providing, payment space, lending space, to the segment that banks were not lending. So there was a class of fintech called B2C who went into that space and they were responding to that sector. And banks didn't think that as a competition, because anyway, the banks were not lending to that sector. It was a fintechs who were lending sector, almost like they're filling a gap which banks were not filling, were not servicing. No competition there. But there were a group of fintechs, almost 80% of fintech in Asia, who started thinking very differently. How? They started targeting the bank's own tech stack, and they told to the banks, look, we can make your technology better. We can make your customer experience better. Please collaborate with us. So there's a whole philosophical, cultural shift happened in Asia where the fintechs became partners with the bank. And what you saw in Asia from 2016 till now, a lot of these banks started partnering with fintech to solve specific legacy issues they're having, whether for credit decisioning or whether robo-advisory, whether it is payment services, whether it is back office automation. There's a whole slew of fintech which started coming in, and what we typically call as business to business fintech. So they went and partnered with the bank, and what we see in Asia today, a tremendous uplift of the incumbent who now call themselves also fintech. Remember 5-6 years back, the fintech was not a great word in the banking sector. Now you ask every bank CEO that says we are a tech company, we are a fintech. So that's the shift. The fintech disrupted the minds of the CEOs of the bank in Asia by telling them behave like a fintech, be like a fintech, serve consumers' need in the real way. So that's a big shift. Now, I think what the question you had, what are the regulatory incentives which created that shift? So I'm going to spend some time on that. The first regulatory shift happened in Singapore was we started thinking about, I think Aniko spoke about it, is how do you build a culture of innovation? And the culture of innovation is not saying that we should innovate, but participating in the process. And the way regulator responded to that participation need is to start thinking about sandboxes that, well, we are willing to experiment with you on these ideas, because the era of policy driving regulation or era of paper processes driving regulation change is over. It is all tech driven. Paper cannot drive change. Is a process of experimentation which will drive change. So regulators started getting into the world of sandbox. And I want to clarify here, the sandbox is a highly misunderstood word. It is a very seductive word to make you feel that we are doing something. But let me demystify the world of sandbox a little bit here. There are two kinds of sandbox. There's a regulatory sandbox and there's an industry sandbox. Regulatory sandbox are where a regulator is saying to the community, look, if you have a product which you think can help the financial sector, come to us. We will work with you on a regulatory sandbox and we'll find a way to make it work for you. Now, the only candidate who can make to regulatory sandbox are the candidate who have a clear description of the solution that they're trying to build and clear articulation of what policy, what prevailing policy at that point of time is preventing that idea to come to the market. And if they can explain that, then they come to the regulatory sandbox. And what happens is that once they come there, regulators define the boundaries and they experiment for 6-7 months. And after that, they have to apply to the full regulation and they go into a market and they deliver the product. That process is very stiff because what comes out of that pipeline, almost like 95% don't make it to regulatory sandbox. Only 5% make it, because what we found out through our own process is that almost 80 to 90% people who apply to regulatory sandbox don't make it because they cannot articulate what policy barrier stops them to do what they want to do. So that's one. But this applicants are not bad because they are bringing good technology. So for them, we created something called an industry sandbox in Asia called API Exchange, which is essentially a public cloud-based platform where fintechs can work with the bank and rapidly prototype, find a way to educate the incumbent so that they can adopt this technology as part of their own digital transformation. So having two sandbox helped create a more comprehensive regulatory approach or policy approach to promote the idea of innovation and experimentation. The second aspect is public infrastructure. Because we are talking about digital economy, it is important for the policymaker to build real digital rails. And I'm going to talk about what we call as a foundational stack. It involves four things. What we did in Singapore and happening broad in Asia is build a national public infrastructure for digital identification, digital identity, because the world of digital economy is going to revolve around two things: an individual digital ID and a corporate digital ID. Having a public infrastructure for digital ID creates the necessary safety net as we move to the world of tech-driven financial services. Second, an interoperable payment system. What I meant by that is that you have faster payment system, you have advanced payment system, but it doesn't make it simple. So what happened in Asia that we start building in Singapore something called a proxy system, which means you and me can pay in Singapore in 3 clicks, 0 cost, and all I need to know is your national ID or your mobile phone number. This is absolutely a foundational infrastructure required on which the whole financial services will be delivered in the digital form. Third, a trusted national data infrastructure. In the world of fake news and fake data, it is absolutely important for a national infrastructure on data. Certain data are critical for the sector, and that should be available to a national utility. We built something called MyInfo in Singapore, which now becomes the foundational infrastructure for eKYC, because you cannot have a digital-driven financial sector where the KYC and account onboarding process is paper-based or physical. It has to run on a digital infrastructure through a trusted data system. Fourth is delivering an electronic consent system, because in the world of fintech, in the world of digital banking, you got to empower your citizens the right to share data, right to manage data. Having a digitally delivered consent system is critical. So that's the second fundamental policy available called public infrastructure for driving a digital economy. Third is to upgrade the skill set, because you can imagine a digital bank, you can always imagine a digital financial sector, but we need to change the DNA of the manpower or the workforce of this whole sector. We have to upskill, reskill, build a whole set of capability upgrade so that they are ready to make that shift. So the fintechs themselves and the banks themselves went through the massive talent upgrade program so that we get the right skill set to drive the future. Fourth, I would say that the regulation itself? How do we build a regulatory response to the changing business model, changing product and services construct? So we started fine-tuning existing regulation. For example, we looked at a payment regulation, which moved from a large single regulation to an unbundled, broken, small activity-based regulation. So one of the regulatory response to fintech and disruption is to shift from an entity-based structure to an activity-based structure, where you regulate for a certain activity, for the risk it posed and the opportunity it brings. So find a balance between regulation and innovation so that you don't create a risk, inherent risk in the system, but you manage consumer protection, you manage AML, CFT expectations, you ensure the financial stability is well protected. So that's the regulatory response, whether it is a consumer banking or it is wealth banking or trade finance, the whole asset class, or insurance. So that's the 4 regulatory response, conducive response to make that shift. Now, what kind of resulted today? A far more digitally enabled banks who are no more called as incumbent because they're already partnering with the fintech to drive that outcome. So that's on the first question. Quickly on the second question, on the central bank response to digital currency. As you know, Singapore started on this journey 4 years back, and we had a very marquee project called Project UBIN, UBIN. The reason we started the project, because no point us putting a policy stance without us experimenting on that whole thing. We started experimenting on digital currencies, on a use case for a payment system. We almost imagine how a payment system will look like if you have a digital currency. And that was Project UBIN. We spent 3 years, 5 stages. Now we have concluded saying that one of the useful opportunity in the digital currency from a central bank point is the wholesale currency. That can help to make a better wholesale payment, cross-border payment more efficient. In fact, by end of this month, as an example, will be the first country which connects, in fact, 2 countries connecting the domestic payment system for the first time will happen end of this month. But even if you have connected our domestic payment system with Singapore and Thailand, we still have not solved the core legacy settlement issue between cross-border payments. I think that has a huge opportunity, and digital currency can solve for it. When it comes to retail digital currency, Singapore unfortunately don't have a use case to go after it because we are a highly banked, highly efficient payment system. We didn't see a need for that. Having said that, it doesn't mean retail digital currency is not required. Many countries in Asia, at least one country called Cambodia, has gone ahead and put together because there's a real need for a efficient retail currency, especially leapfrogging the domestic payment system to make it more efficient. And last point, the future is moving to the whole world of tokenization and the whole asset tokenization business. I think from a regulatory perspective, between cryptocurrencies, which is non-asset backed currencies, then the tokenization asset, we see that there'll be 2 different split. One will have a reaction from a consumer protection, AML, CFT, financing regulation to control that we don't do anything funny on this whole space of Bitcoin. But on the tokenization side, there'll be a real shift of financial asset, because we are moving from a physical banking to a dematerialized digital banking to a fractionalized asset banking, which is in the world of tokenization. I think that will see a significant shift in terms of regulatory response, and I'm quite optimistic that will bring more value than what we see today.